Welcome back, everyone. We hope you enjoyed the individual presentations from our fund managers. The next leg of this event is a panel discussion. Next to me, I have Junaid, I have Rashad, and I have Omri. And these gentlemen will be answering a few of my questions today. Gents, Q1 has been a positive for both global and local markets. What are some of your thoughts on this, and can we expect this to continue throughout the year? I'll start with you there, Omri.
Yeah, I think if we go back to the fourth quarter of last year, there were quite a lot of concerns, and I think the markets became a bit more comfortable with the new sort of macro environment that we're operating in, and we saw quite a strong rebound in especially equity markets. We are a bit concerned that the market is a bit complacent with the macro risks that are still out there. Valuations do almost take into account that we're going to get a soft landing, and I don't think that's a guarantee. So we are a bit concerned about valuation levels and about the sort of outlook for global markets at this point in time.
Just moving on, we are getting mixed signals from both bond and equities. Bonds are pricing in a recession, and we see that equities are seeing a bit rosier outcome. What are some of your thoughts on that, Rashad?
So I think, firstly, we have to disabuse ourselves of the notion that equity markets fall in a recession. Equities are a function of earnings as well as the discount rate. Yes. And the discount rate has been the dominant driver over the last decade. So we live in a market where the phrase is bad news is good news. So when data comes out, for example, a non-farm payrolls will come out and it's worse than expected, the market will go up because they think a bad labor market means the Fed's going to ease more. So monetary policy has been the bigger driver. And you can't really read that much of recessionary indicators into an equity market. The bond market's a different story because bonds are just expectations of future interest rates. And if the yield curve is inverted, it means that the market's expecting rates to go down in the future. Why would it expect that? Because it expects Fed easing. And why would it expect that? Because we're going to get a recession. So the bond market's definitely giving you a very strong signal that a recession is coming.
And maybe just touching on inflation a bit, what are your thoughts on inflation for the rest of the year? And your view on inflation-linked bonds versus nominal bonds? I know that inflation-linked bonds have been doing quite well over Q1. So what are you seeing going forward?
So I think inflation-linked bonds have been doing quite well. We started adding them to our portfolios towards the end of last year, and they have performed. And I think it's going to be an important asset class in the year ahead. So if you look at where inflation is now, it's still elevated. But in South Africa, we will be within the target by the Q3 or Q4 this year. US inflation still above 5%. But by the end of this year, we should be down towards the 3 level, and maybe if we're lucky, 2.99. So I think that will give a little bit of a breathing room. So in the near term, inflation will moderate. The question is, going forward 2-3 years down the line, I think inflation is likely to be stickier than normal. And we're not going to go back to either, the midpoint of the target in South Africa, 4.5, even though Lesetja Kganyago is talking about 3. I think those are that's very unrealistic. Also, the Fed going back down to, getting that inflation back down to 2%, it's just going to be too painful. So I think stickier inflation and good for inflation linkers on a structural level.
I just want to bring in Junaid into the conversation now. What are your thoughts on SA equity valuations? And maybe, Omri, you can add in terms of global valuations as well. What are you guys seeing there?
So I think SA equity valuations, we're seeing a lot of opportunity in the local markets. I think if you look at a domestic SA index, probably trading on a 10 multiple, more than one standard deviation cheap. And you could argue that there are lots of risks. From a macro perspective, we've seen lots of GDP revisions downwards to 0.1%. We're in a structurally low growth environment. So there's lots of risks, but we think it's a stock pickers market. We think there are lots of opportunities where excessive pessimism has been priced in, where markets are basically factoring in, or analysts are forecasting that for example, load shedding costs will just continue in perpetuity, which we don't think is the case. So we're seeing lots of opportunity in the SA market.
Yeah, I think in global equity one has to be selective. I think I agree with Junaid. There are some local opportunities. Your investment universe globally is just so much wider.
Yes.
So, I mean, we have shifted some of our SA equity exposure offshore. I mean, there are select markets that we like. And I think one's in the position where you can take a separate decision on your foreign equity exposure and the FX exposure that you want.
Yes.
You can hedge back the currency exposure if you worried about the rand being too weak and it's going to strengthen. I mean, it's been sort of one-way traffic more recently, but in the last decade there's been 2 or 3 times where we've actually seen significant rand strength. So you can take your currency decision separately. So in terms of the global equity market, we think US equities look fairly expensive. We do find value in Asian and specifically Chinese equities, and also in Europe we're finding a bit of value.
Thank you. So sticking with the global markets, we saw 3 US banks, Silvergate, SVB, and Signature Bank, and Credit Suisse collapse in March. This brought a lot of fear into investors. People are thinking we are going back to 2008, and I have to ask this question. Is this really a banking crisis, or is the market overreacting? And what are some of your thoughts on that? Rashad?
Yes. I think if you look at the reaction of the Federal Reserve and the Treasury, what they did over that weekend, effectively there was a rule where you had deposit insurance of $250,000. That was thrown out the window, and they did a blanket guarantee on all depositors, which might just feed through into the rest of the system. And they launched a new program to effectively fund the banks. So it was a seminal event, I think, in history where effectively the entire US banking system was backstopped. And that's because it was a very real crisis. Yeah. Banks piled into long bonds at the lowest yields in history. And that was a massive error, and they're sitting with massive unrealized losses on their securities and their loan books. They've basically wiped out their capital, and we haven't even started the recession. So if you look at history, big losses from banks come from credit losses when people default in a recession. So we haven't even started that, and already they've wiped out their capital. So this is definitely a big event, and I think we're going to see more failures coming through as the banks continue to bleed.
And I mean, just to add to what Richard said, it's also introduced the moral hazard, because that limited guarantee on the deposits, it kept banks honest. But now, I mean, it's not a crisis now, but it creates the crisis of the future by sort of backstopping the whole banking system. And it comes at the cost of the taxpayer eventually. Yeah.
Junaid, what are you seeing in our banks here in SA in terms of asset liability matching? Could what happened in the US come to South Africa?
So I wouldn't say never, but I think our banking situation is very different. I think the SARB does an excellent job in terms of stringent regulation. So I think with some of the smaller banks, there was a lapse in regulation where they actually relaxed some of the regulation that was put in place after the GFC to prevent these sorts of things from happening. Yes. So if I look at, for example, unrealized losses on our bank's balance sheets, I mean, it's a few percentage points of their capital, so nothing to be concerned about. I think also if we look at the depositor base, it's a lot more diversified. I think a bank like Silicon Valley Bank was very concentrated in a niche sector, where our banks are a lot more diversified. And then also, investing longer term, when they do that, they hedge it. Yeah. Also, so I think risk management is a lot more prudent, and then disclosure. Some of those banks didn't have to disclose, so liquidity ratios, net stable funding ratios. Where our banks disclose that, so there is visibility when things do pick up. You can see it coming. So I definitely wouldn't expect that. I think it's a very low probability that our banks experience that. And then also the flight to quality. Our big banks, call it the 5 big banks plus Investec. It's all quite, in terms of quality, it's the perception of quality is there. So I wouldn't say that, you're going to have a flight to quality anywhere else.
I think we run.
Yeah.
I think the important thing in South Africa, we run a very floating rate system. So when you take a mortgage out, you're paying a floating rate linked to prime. It's not like the US where you get a fixed rate mortgage. When corporates borrow, the banks give them a floating rate, and it's a corporate's responsibility to manage the interest rate risk and hedge. So that gives banks a very natural hedge. So that blow up on the interest rate side is not, it can't happen here because we run a different system. But what the problem is in South Africa is the poor state of the economy, and eventually that will take its toll and you will see credit losses.
Yeah, I think in addition, our banks are extremely well capitalized. I think the banks are well provided for at this point in time. I think if the economy deteriorates, we will see credit losses increasing. And I think we've got a very good banking regulator. That's actually, if you look at the global financial crisis, how well we came through that, it's been well managed for a number of years, and we've got good banking management teams who understands banking. So I don't think we run the same risk as we do with global banks.
I mean, in the US, just to emphasize, the regulator didn't even test them against interest rate rises. So that just shows the incompetence of regulation in the US, whereas here we don't have that problem.
Yeah. I'm glad you can say that. That means I don't have to hide my money under the mattress or a couch. It's safe at a bank. Maybe
and
just
you're safe at Nedbank.
And I'm safe at Nedbank. Just sticking with the banks, global subdebt took a knock because of this. Rashad, how is subdebt in the local market been?
Yeah, so, I mean, what is subordinated debt? It's a fixed income asset like a bond, but it actually counts part of capital. And after the financial crisis, they actually changed the structure of subdebt that it can actually be written down to recapitalize the bank. So you can go from 100 to 0. That wasn't the case before. So we have seen a big shift in what subdebt means, and every now and then we get a case where a bank gets into trouble and suddenly fixed income investors, bondholders get wiped out, go from 100 to 0. And we saw that with Credit Suisse. $17 billion of subdebt just got written off overnight. So I think it is a lesson that for investors that you got to understand what you're buying when you buy a bank bond. You can't just look and say, oh, I've got Nedbank or Standard Bank and I've got a safe asset. You have to look at where you sit in the capital structure. And I think that it's highlighted the risks which people have ignored. I think they are too expensive. And in the local market, you haven't really seen a reaction to what's been going on globally. And I think, therefore, it's one to avoid. And I think you want to be sticking to very high credit quality at this point in the cycle.
In addition, I think what's happened is that debt was always actually underpriced. So you didn't pay, or the coupon that the companies paid on it wasn't high enough to compensate for the risk. And I think it's highlighted the risk. It's also made future capital raises in that sector a lot more difficult, because suddenly investors have realized, listen here, I can actually make a loss there. It's just not a free ride at a nice spread and margin above risk-free assets.
I want to just bring it back home now. I know also in March we also had our own problems with transaction capital, with its pre-close statement, which the market didn't like. Omri, I know that you had less than a percentage in the Net Group Investment Opportunity Fund in that stock. What are your thoughts going forward on transaction capital?
Yeah, I mean, our stake is a recent purchase, so we bought it at relatively good levels. We thought good levels. We could have got better levels after the trading statement. We saw severe impact on the share price post the write-down of the SA taxi business. We still think there are some incredibly good businesses within transaction capital. We've seen a lot of foreign investors, which it was a favorite of exiting the share, and we think that creates opportunities. WeBuyCars, we think, is a fantastic business that keeps on growing market share. They've got a lot of organic opportunities within the business. So at the low levels, we actually increased our shareholding. It's still a small position within the fund, less than 0.5%, but we think at current prices, and also the different businesses are ring-fenced. That was the concern of the market had, that there will be an overflow impact on the other businesses. It's all ring-fenced. So if SA Taxi, as an example, goes against the wall, it won't affect the other businesses. So we think the risks are compensated for at current levels.
Juliet, I just want to get your thoughts on this. I know that you didn't actually hold any transactional capital in your portfolio. Maybe what were your reasons, and what are you thinking about the stock going forward?
So I think, look, it's a phenomenal management team. I think they're very entrepreneurial. We did own it in the fund some time back. It got too pricey for us, and we exited the position. I think in hindsight, I think possibly the multiple the market was willing to put on those businesses just got ahead of itself. And I think, it probably looks more interesting at current levels. I think there are still some question marks around whether SA Taxi still needs some more capital. But I agree with Omri in that We Buy Cars is a great business. I mean, it's consolidating what is a very fragmented market and putting some trust into a market where there's typically a lack of trust. And then the other risk services business, quite small in there, but also growing. So I think those two businesses could probably still do double-digit earnings growth over the medium term in a constrained South African environment. So I think it probably looks interesting at these levels, but we didn't add any to our fund. Yeah.
And I guess that's the beauty of the best of breed model, where you have two portfolio managers that think differently, and I think that's what makes us quite unique. Just sticking with SA, China's reopening, the rand weakness, how is that playing out in the commodities space? Maybe I'll go back to you, Junaid.
So I think the Chinese reopening, I think iron ore possibly, normally, 60% of demand goes to China. We've seen iron ore has been very resilient. I think we've had a bit of dollar weakness, so supported commodities. PGMs have come off a lot on concerns about, the pickup in EV penetration has been a lot quicker than people had expected. And in gold, we've had a phenomenal run in gold since the beginning of the year. And oil, we're still very constructive on oil going forward.
Yeah. I know, Rashad, that gold as well was something that you spoke about lately. What are some of your thoughts on gold?
Yeah, I think gold is one of the most forward-looking assets. So it's looking past the recession. It's looking towards monetary easing, which I think, given the debt burdens in the US and globally, I think you will need to have easier policy. I mean, things are falling over. Last year, the housing market in the US effectively ground to a standstill. You then had commercial real estate early this year, even before the banking crisis. And now we're in a very deep banking crisis. Banks will continue to bleed. And it just shows you that if you build an economy on zero rates for over a decade, you can't suddenly take rates from 0 to 5% and expect everything to just act as normal. I think that you can see a lot of things breaking and lots of intervention needed to hold things together. So I do think the market is looking towards monetary easing later this year, and inflation remains sticky, and I think therefore gold is an asset to hold in the years ahead.
Yeah. I just want to talk about a little bit about currency. So what do you guys think about de-dollarization, and could the Chinese yuan be the next global currency? I can start with you.
No, it's Rashad's area.
I can start with you. I can start with you, Rashad.
Okay, look here, I think the thing to remember is the Chinese yuan is still pegged to the dollar, and it's controlled by the Chinese central bank. So you can't be a replacement for the dollar when you peg yourself to the dollar. It's not an open currency. It doesn't trade. And therefore, I think it's very premature to think that the Chinese yuan can replace the dollar. The key is, the U.S. dominance of the global economy has been in decline. At one stage, the US was 50% of the economy. We've never seen an empire of that strength in history. Even the British Empire, the Roman Empire, it only got to about 25%. So it's not surprising the dollar is the dominant currency, and we all think in dollars. But at the moment, the share of the global economy of the dollar has declined from that 50%. It's down to 25%. And since the 1980s, China has gone from 2% to 20%. So you are seeing a shift, but the yuan is not really to replace it. And I think more likely we get a situation where the dollar declines in importance, but we don't necessarily get one currency to replace it.
Thanks for those thoughts. Just bringing it back home, we know that next year we have elections. How are you thinking about your portfolios to make them a bit future-proof when that situation comes? We might have a coalition government, and all of these things are at top of the mind for our investors. So how are you guys thinking about your portfolio construction right now and into the future?
I think you always need to take a pragmatic approach, so diversify your portfolio. So within the context of an SA equity fund, you've got your rand hedges on the one side, and you've got your domestic stocks. So having a diversified spread across those, and then having enough margin of safety, because there will be volatility as we go into elections over the next probably 12, 18 months. And so having enough margin of safety in that. And I suppose, looking through the noise as to how much of is there actually a permanent impairment in a company or an asset versus something that's just, a blip on the screen.
Yes. Just moving on, I've been hearing a lot about VUCA. So I've been listening a lot to commentators talking about VUCA. I initially thought it was VUSI, maybe a new minister of potholes or something. But I learned that it means volatility, uncertainty, complexity, ambiguity. And I think this is the current environment that you guys are managing our clients' money in this current environment. So what are some of those strategies that you guys are using to manage these portfolios in this kind of environment?
Yeah, so I think you're spot on. I mean, those are that is what's happening in the market. But I think what it's also done, it's introduced opportunities. So we were in an environment where a major part of financial markets were uninvestable, with global bond yields basically at close to zero. So with things normalizing, with rates starting to normalize, suddenly your investment universe is expanding. The volatility introduces investment opportunities, both tactical and strategic. And I think one can build a decent, diversified portfolio. There are some asset classes offering attractive real returns at this point in time. So I agree with Junaid. If you put enough diversification within your portfolio, one can still structure a very good yielding long-term portfolio.
Yeah, I think we are in a very significant part of history, because firstly you've got a transition of global powers, which we've talked about. President Xi and Putin met recently, and Xi told Putin, we haven't seen change like this in 100 years. Yes. And he said, and we're the ones driving it. And he said that with the translators around. So they are trying to send a message to the US that, there is a shift happening globally. So I think we are going to be in a more uncertain period going forward. So I think you do have to understand your goals in terms of your investments and choose a strategy and stick to it. Don't chase the narratives from here to there. I mean, at the last year it was the China reopening trade, and the market has a habit of turning excitement into pain. So as you see a narrative, people pile onto it, and then it turns around. So I think, pick your strategy and then stick to it.
I completely agree with Omni and Rashad. I mean, I think if you look at the opportunities that presents itself because of overreaction, I mean, look at transaction capital down 60% after a trading update. So it overreacts on both sides, and it creates opportunities for us.
Yeah. And with that being said, I think we'll close this session. So thank you so much for listening. Thank you for tuning in. And as the panelists say, stay invested and stay safe. Thank you.